So I'm doing a couple things. I'm where the market has been too generous to me, I'm taking some money off the table. I'm doing some selling. Where I've made mistakes, I'm selling ruthlessly to book the tax loss so that I get to keep some of the money that I made in decisions uh, that were good to me. I would say on a risk versus reward basis that the best place to be is probably in the gold trade. It's unusual from my point of view to find high quality gold companies, irrespective of market cap, that is to say, the best of the best or the best of the juniors, priced reasonably. And I see them being priced reasonably. I'm not trying to say that the biggest gains that you can harvest will be in the gold sector, but if you juxtapose risk to reward, and if you look at the valuations of the good companies in the sector relative to their historic norms, when I say price versus value, I'm really talking about enterprise value versus net present value. Uh, that sector seems attractive to me. The sector, too, has, pardon the pun, but lost its luster. The US dollar has been quite strong post Trump's election, and there seems to be euphoria in the United States that the Department of Government Efficiency, led by a person who became a billionaire on subsidies, is going to do some spectacular job um, reducing the size of the U.S. government. I think that's utter fiction. I don't. I don't think that we'll run out of that perception anytime soon. Which is to say, I don't think that you're going to see a panic into gold anytime soon. But I do think that the overall arithmetic of the maintenance of purchasing power in the U.S. dollar uh, is going to continue is silly. I think the dollar will do well compared to other basket case currencies, your own included. I think the dollar will do well against the euro. I think it'll do well against the Swiss franc. I do think it'll do well against the British pound, the Canadian dollar, the Australian dollar, all of that. I don't think that we will maintain purchasing power in the US dollar. And as a consequence of that, I think the gold trade on the basis risk to reward is the best trade I see.
What are you selling though? You started it off by kind of teasing me on selling. What have you been selling?
Well, I've had some juniors in particular that have done too well, I think. They're beginning to be priced for perfection. Uh, and I don't want to name any names because they're old friends. But I had circumstances where I owned the stock because I thought I'd see 150% return, in 2 or 3 years. And I've seen that return in 2 years. And when a stock meets my target, and where I see it at a premium, when I say a premium, when I see the enterprise value of the company being 160 or 170% of uh, what I consider to be its net present value, unless I see a really, truly spectacular uh, development pipeline, I try to switch from names that are fully valued to names that aren't fully valued. That's just sort of what I do. And I the junior silver sector. I remember on an interview with you probably a year ago, maybe longer, just saying I'm not making a silver call, but the junior silver stocks are widely, widely, widely reviled. I think I used the phrase coiled spring. And that negative sentiment got erased in a year. I had anticipated that either the silver price would increase, which it hasn't really, it's increased some, or that the silver stocks would claw back from the hate over 3 years. But they clawed back from the hate in 6 or 7 months. The other thing that I've done, the other side of selling, has been I sold mistakes. Chicana was a mistake. It And I think I said fairly broadly, and I'm not picking on Chicana, but rather using it as a name to represent a basket of exploration stocks. When you uh, take a decent sized position in an exploration company, your anticipation needs to be failure. You need to believe that the most likely outcome is you're going to lose 25 or 30% of your money, because the reason that you're doing it is you're anticipating a small chance of a stupidly large success. Again, using Chicana as a sort of a teaching lesson, the market capitalization there at the time I got involved was about 6 million Canadian dollars, I think. Had a dollar 98 in the bank, so all of the money was accorded their inventory of breccia resources, high quality breccia resources on top. But the exploration thesis was interesting to me. They had a very large golden soils anomaly, and it was pretty obvious that there was some energy source, some mineral source for the high grade surface breccias, which was interpreted conveniently as a large porphyry. A group of us put some money into to test both of those theses. And thus far, neither of them has turned out to be true. When the reason that you own a stock goes away, the stock must go away. And so, in failed exploration bets, I've sold. Well, to the extent I can. I haven't sold all my Chicana because I have a lot, and there's not a very big bid. But certainly across my exploration portfolio, those companies that have failed to demonstrate the thesis or made substantial progress in demonstrating the thesis had to be sold and were.
But you haven't sold anything thematically where you're like, oh, I don't like whatever commodity anymore. I'm going to sell everything out of
No,
that commodity.
I think the commodity that I have the biggest position in that affords me the biggest risk in the near term is probably oil and gas. Um, to the extent that we have a restoration of relationships between Russia and the West, which is to say that there's some resolution of the conflict in the Ukraine, I think that the wind in the sails represented by the hiatus, partial hiatus in Russian natural gas shipments to the West ends. And I think that some of the delta between the North American pricing for BTUs and in particular the European pricing for BTUs goes away. I'm not saying that's going to happen, but it looked like it was, and it was fairly clear sailing in the oil and gas business for a couple of years. The equity prices have not actually kept pace with the increase in cash flows that the companies have enjoyed, and that's been nice. The companies have generated an awful lot of free cash, which the market hasn't noticed. But there are headwinds rather than just tailwinds in the thesis today. There's some improvement in the thesis too. Ironically, because the swing producer in the world really is the United States. And the increase in American production that we've seen as a consequence of a convergence of technologies, but also a very low cost of capital, is beginning to ebb, simply because at today's energy prices, at today's cost of capital, we've done an amazing job of drilling through our tier one locations over the past 5 years. And we're getting to the point where, with the exception of some companies like Exxon, uh, we are beginning to develop a real reduction in tier one locations. Now, understand that there's an interplay between commodity prices, tier one locations, technology, and the cost of capital. If the president manipulates the interest rate lower and reduces the cost of capital, then some of the tier two locations become tier one locations as a simple consequence of the cost of capital. But I would say that the sector where my enthusiasm has been moderated the most, particularly in the speculative side, in the small companies, is in the energy or oil and gas sector.